In the year 1900, a man walked into a bank and asked a stranger to trust him with money he did not have. There was no number attached to his name that day, no file the banker could pull up, no score printed on a slip of paper, no algorithm quietly weighing his risk before he had even finished speaking his request aloud. There was only a man standing at a counter and another man behind it, deciding, in that moment, based on nothing but instinct, conversation, and appearance, whether this particular stranger deserved a chance. Perhaps he wanted to buy a small parcel of farmland. Perhaps he needed capital to open a shop, or a loan to see his family through a hard winter after a bad harvest. Whatever he needed, the process was the same everywhere in America. He would sit across a desk from a man he had likely never met before, and in the space of a short conversation, that man would render a verdict that could shape the rest of his life and the lives of his children after him. Today, that decision happens in seconds. You apply for a mortgage, a car loan, a credit card, and somewhere in a database a 3-digit number appears, a score between roughly 300 and 850, and that number, more than almost anything else about you, decides your fate. Banks do not need to meet you. They do not need to like you. They do not need to know your face at all. The algorithm has already decided. It feels cold, impersonal, a little unsettling if you think about it too long. The idea that a machine somewhere has quietly ranked your trustworthiness as a human being without ever once looking you in the eye. So it is tempting to imagine that the world before it was warmer, more human, a time when a real person looked you in the eye, judged your character the old-fashioned way, and made a decision no algorithm ever could, a fairer decision, rooted in genuine human understanding rather than cold math. Before you accept that comforting picture, ask yourself something. If a stranger walked into a bank in 1900 with no credit score, no financial history on file, nothing but his word, what, exactly, was that banker actually judging him on? Hold that question, because the answer is far stranger and far more troubling than most people realize when they first hear it. For nearly 150 years of American history, there was no credit score, no standardized number, no algorithm. The entire system of lending in this country, who could buy a home, start a business, or simply survive a hard winter on borrowed money, rested almost entirely on the personal judgment of individual men, bankers, loan officers, local businessmen who happened to control the only capital in town. And here is the uncomfortable truth beneath the nostalgia. Human judgment does not exist in a vacuum. It carries opinions, assumptions, prejudice. When a banker in 1900, or 1930, or even 1960 decided whether you deserved a loan, he was not running some pure, unbiased assessment of your finances. He was deciding whether he trusted you, and that trust was shaped by everything he believed about people who looked like you, prayed like you, or lived on your side of town. Hi viewers, would you rather have a real, live person decide whether you deserve a loan, or a computer using pure numbers? Think carefully about your answer. You may change your mind before this story is over. For generations, an entire nation's access to money, the ability to buy a home, expand a farm, launch a business, or simply weather a crisis, depended on convincing one man that you were worthy. Not worthy in the sense of having enough income to repay the debt, worthy in the deeper, murkier sense of belonging, of being the right kind of person. And if he decided you weren't, there was no appeal, no second opinion, no way to challenge his verdict, no form to file, no higher office to write to. The door simply closed, and it often stayed closed for an entire lifetime, sometimes for an entire family, for generations. This was not a rare injustice, some isolated case of one bad banker in one small town. It would eventually become something far larger, something drawn onto actual maps, stamped with the authority of the federal government itself, and quietly built into the very architecture of how the richest nation on earth decided who got to build wealth and who did not. A decision made once, in a single office, in a single afternoon, could echo through 3 or 4 generations of a single family, shaping not just where they lived, but what they owned, what they could pass down, and what opportunities their grandchildren would inherit, or never have the chance to inherit at all. But that revelation lies further ahead. First, you have to understand how this strange, deeply personal system of lending actually worked, because it began not with banks at all, but with a New York merchant who had an unusual idea about how strangers might learn to trust each other from a distance, using nothing but letters, opinions, and whispered reports about a person's reputation. It would become the ancestor of everything that came after, an entire industry built on judging character rather than simply counting money. And it would take nearly a century and a half, a landmark set of laws, two mathematicians who believed a machine could do better than a man, and a fight over discrimination that reached all the way to Congress, before America finally decided that a number might be fairer than a human being's opinion. Was it? That is the question this story is really asking. Because before you can understand why the credit score exists, you have to understand exactly what it was built to replace, and why so many Americans, for so long, were never given a fair chance to be judged at all, no matter how honest, how hardworking, or how creditworthy they truly were. To understand this strange world of personal judgment, you have to go back to the very beginning of American credit reporting, to a New York silk merchant who never intended to invent anything at all. His name was Lewis Tappan, and in 1837 he watched his business nearly collapse in one of the worst financial panics the young nation had ever seen. Tappan and his brother ran a wholesale silk business in New York, and the panic wiped out client after client, leaving the Tappans scrambling to recover debts from merchants who had simply vanished. Tappan had learned, the hard way, just how easy it was for a dishonest debtor to vanish into the vast, half-settled American frontier, taking someone else's money with him. A man could assume a false name in one state and open a new business in another, and no merchant back east would ever know his true history. There was no way to check a stranger's story, no way to know if the man asking for credit in your shop had already ruined 3 other merchants in 3 other towns. So in 1841, Tappan built something the country had never seen. He called it the Mercantile Agency, and its purpose was simple: to systematize the rumors. He recruited what he called correspondents, lawyers, ministers, local businessmen scattered across cities and small towns, and asked them to quietly report back, twice a year, on the character and reputation of the people around them. Was this merchant honest? Did he pay his debts? Could he be trusted with someone else's money? The reports were copied into massive ledgers in a New York office, and subscribers could pay to look inside. It is a small, remarkable detail of American history that some of Tappan's correspondents went on to become presidents of the United States. A young Illinois lawyer named Abraham Lincoln filed reports for the agency. So did a Midwestern storekeeper named Ulysses S. Grant. Future presidents Grover Cleveland and William McKinley did the same. The system that would eventually evolve into modern credit reporting was, in its infancy, staffed in part by the men who would go on to run the country. The agency grew quickly. Within just a few years, it had hundreds of paying subscribers and branch offices opening in other major cities. But not everyone welcomed it. Many in the New York business community regarded Tappan's whole scheme with suspicion, seeing it as something close to organized espionage, a confidential network of informants selling private information about honest men to whoever could pay for it. One outraged critic of the era went so far as to compare it to a new Inquisition, a secret tribunal quietly passing judgment on people who never even knew they were being investigated. That suspicion was not entirely misplaced, because look closely at what those correspondents were actually writing, and the comforting image of a fairer, more personal system begins to crack. These reports were not financial audits. They were opinions, subjective, sweeping judgments about a person's worth, filtered entirely through the beliefs of whoever happened to be writing them. And because nearly all of Tappan's correspondents were white, Christian, and male, their reports carried all the prejudices of the men who wrote them. One correspondent in Buffalo warned subscribers to use particular caution in large transactions with Jewish merchants. Another, reporting from Georgia after the Civil War, dismissed a black-owned liquor store in a single dismissive, dehumanizing phrase. These were not fringe outliers. They were typical of the ledgers, page after page of financial judgments quietly fused with racial, religious, and class contempt. treated as simple fact. Hi viewers, does it surprise you that some of America's first presidents helped build the earliest credit reporting system? Let us know in the comments. This was the true foundation of American credit. Not cold, unbiased math, but a network of human opinion that decided, silently and without appeal, who was trustworthy enough to receive money and who was not, regardless of what their actual bank balance or business record might say. If your name landed on the wrong page of Tappan's ledger, with the wrong word attached to it, that judgment could follow you for the rest of your working life, and there was no court, no form, no process by which you could ever see the file or challenge what it said about you. As the decades passed, this system only grew larger and more entrenched. Tappan's agency spun off successors and rivals, eventually merging into what would become Dun & Bradstreet. Local banks developed their own informal versions of the same practice, relying on the loan officer's personal judgment of a customer's character, his family name, his church, his neighborhood, the color of his skin, as much as his income or his savings. For the small businessman, the aspiring homeowner, the immigrant trying to build a life in a new country, this meant that success or failure often had almost nothing to do with financial responsibility. It had to do with whether you fit the picture of trustworthiness already forming in the mind of the man across the desk. A hard-working black entrepreneur with steady income and a spotless record could be turned away from a loan a less qualified white applicant received without a second thought. A widow raising children alone might be denied credit not because her finances were weak, but simply because she was a woman managing money without a husband's name attached. An immigrant with a thick accent and an unfamiliar surname might find every door in a new town closed to him, no matter how many years he had already spent working honestly to build a life there. There was no metric for this. There was only a verdict, delivered by one man, based on everything he believed about people who looked, prayed, or lived like you, or didn't. Consider what this meant in practice, town by town, decade by decade, year after year. In one place, the local banker might be a devout member of a particular church and quietly favor his fellow congregants when doling out loans, regardless of their actual financial standing. In another, a banker's private feelings about a particular immigrant group, feelings he may never have spoken aloud, may not even have fully admitted to himself, could decide whether an entire family ever owned the roof over their heads. There was no oversight board reviewing these decisions. No regulator checking whether the bank's lending matched the actual creditworthiness of its applicants. The banker was, in his own small kingdom, essentially unaccountable. This informal, deeply personal bias built quietly into small-town banking across the 19th and early 20th centuries, decade after decade, town after town. It shaped who could buy a home, launch a business, or borrow their way out of a hard season. And for a long time, it stayed exactly that, informal, scattered, the private prejudice of individual men operating behind individual desks in individual towns. But that was about to change. In the 1930s, in the depths of the Great Depression, the federal government of the United States was about to take this scattered, personal bias and turn it into something else entirely, something organized, something official, something drawn, quite literally, onto a map, with the full authority of Washington behind every line. The Depression had shattered the American housing market. Foreclosures were epidemic. Families across the country were losing their homes by the hundreds of thousands, and in 1933 the federal government stepped in with a rescue plan, creating an agency called the Homeowners Loan Corporation to refinance troubled mortgages and keep families in their houses. It was, in its stated purpose, a genuine act of mercy, a way to stop the bleeding in a housing market that seemed to be collapsing entirely, town by town, across the country. In its earliest phase, this agency did something almost unimaginable given what would come next. It issued rescue loans to homeowners of every race, including black families, whose properties it helped save from foreclosure, just like anyone else's. For a brief moment, it looked as though the federal government might actually stand as a fair and neutral referee in American housing. But then the agency turned to a different task, and everything changed. Between 1935 and 1940, the Home Owners Loan Corporation set out to assess the lending risk of nearly 240 American cities. The result was a series of documents that would come to be called residential security maps, and they would quietly reshape the geography of American opportunity for the next century. Each map divided a city into neighborhoods, and each neighborhood was assigned a grade and a color. Green for the most desirable areas, considered the safest possible investment, blue for still desirable, yellow for declining, and red, the color that would give an entire practice its lasting name, for neighborhoods marked hazardous. Too risky, in the government's own official judgment, to be worth a loan. And here is the revelation that changes how you must understand everything that came before it. These grades were not primarily based on income, employment, or the ability to repay a loan. They were based overwhelmingly on the racial and ethnic composition of the neighborhood itself. Appraisers filed reports describing the presence of Black, Jewish, Italian, or other immigrant families as a mark against a neighborhood's value, sometimes in language so explicit it reads today as a confession. A neighborhood could be full of steady, employed, creditworthy families and still be marked in red, simply because of who lived there. The government's own logic held that the mere presence of certain families constituted a financial hazard, as though a neighbor's race were itself a kind of contagion that could infect property values. Picture two families living in the same city, in the same decade, doing everything right by the standards of the time. One family, white, in a neighborhood the map colored green, walks into a bank and is approved for a mortgage within weeks, at a favorable rate, with the federal government itself effectively guaranteeing the loan. The other family, Black, with the same steady income, the same savings, the same spotless payment history, lives just a few streets away, inside a red line on the very same map. Their application is denied, or offered only at a punishing interest rate no ordinary family could sustain. Nothing about their financial character was different, only the color of the line drawn around their street. The very next year, in 1934, the newly created Federal Housing Administration adopted this same color-coded framework directly into its own official underwriting manual, the guidebook that told lenders across the country exactly how to evaluate a mortgage application. The bias was no longer a rumor whispered by one prejudiced banker in one small town. It was federal policy, printed in a government handbook, distributed to lending institutions nationwide, and enforced with the full backing of the United States government. This is the plot twist most Americans never learn. Redlining was not the informal, scattered misconduct of a handful of bigoted bank managers acting on their own, quietly overlooked by an otherwise neutral government. It was the deliberate architecture of federal housing policy, drawn on official maps, sanctioned by an official manual, and applied to almost every major city in the country. And the human cost was staggering. In the years that followed, the post-war economic boom sent millions of American families into brand-new suburban homes, financed by cheap, government-backed mortgages, and further fueled by the GI Bill for returning veterans. Entire new towns rose almost overnight on the edges of American cities, row after row of affordable homes built specifically for young families starting out after the war. For families in the green and blue zones, this was the greatest wealth-building opportunity in American history, a home whose rising value could be passed down for generations, the very foundation of the modern American middle class. A returning white veteran could buy a starter home for a modest down payment, watch its value climb steadily for 30 years, and eventually hand that equity to his own children as a down payment on their first home in turn. For families trapped inside the red lines, that door simply did not open. It did not matter if a black veteran had risked his life fighting in the same war as his white neighbor. It did not matter if he had steady work and a spotless record. The map had already decided, before he ever walked into a bank, that his neighborhood, and by extension his family, was not worth the risk. Denied the same mortgages, families in redline neighborhoods were locked out of the very mechanism by which millions of other Americans were building the wealth that would define an entire generation's future. Many were forced instead into predatory alternatives, contract sales that offered none of a mortgage's legal protections, where a single missed payment could mean losing both the home and every dollar already paid toward it, with no equity ever accumulated at all. This was not an accident of history. It was policy, and its consequences did not fade when the maps themselves were eventually forgotten. The wealth gap it manufactured between black and white American families would still be measurable and painfully wide generations later, a direct, traceable inheritance from lines drawn in red ink by government appraisers in the 1930s. For decades, this system faced no meaningful legal challenge. It hardened into simple, unquestioned custom, the way banking had always worked, the way it was assumed it always would, passed down almost like folk wisdom from one generation of bankers to the next. But by the middle of the 20th century, the civil rights movement was gathering a force that would eventually turn its attention directly toward the banking industry and toward the government maps that had made discrimination not just common, but official. The country was about to be forced, for the first time, to answer a question it had spent a century avoiding. If a stranger walked into a bank and a loan officer looked at his face instead of his finances, who exactly had given that banker the right to decide? The answer, when it finally came, would not be simple, and it would arrive from a direction almost no one expected. By the 1960s, the pressure had become impossible to ignore. Civil rights advocates were documenting, case by case, the systematic exclusion of black families from the mortgage market, compiling testimony and statistics that made the pattern impossible for lawmakers to credibly deny any longer. Women's rights advocates were compiling their own devastating record, stories of married women turned away from loans because a lender assumed she might soon become pregnant and stop working, of single women told flatly that no bank would extend credit to a woman without a husband's signature, regardless of her income or her credit history, of divorced and widowed women discovering that decades of responsible bill paying had been recorded entirely under a man's name, leaving them with no credit history of their own to show. The old system of personal judgment, once defended as intimate and trustworthy, was being exposed for what it had so often actually been, a legally sanctioned mechanism of exclusion. In 1968, Congress passed the Fair Housing Act, outlawing discrimination in housing transactions, including mortgage lending, on the basis of race, religion, and national origin. It was a landmark law, but a law on paper and a banker's private judgment behind a closed office door remained two very different battlefields, and lending discrimination persisted, hidden inside decisions that were rarely written down and even more rarely explained. The next assault on the old system came from an unexpected corner, not primarily from the civil rights movement, but from a rising tide of women demanding the right to manage their own money. A congressional aide and eventual law professor named Dr. Emily Card had been personally denied a credit card and a home mortgage simply for being an unmarried woman, and she turned that experience into a campaign, gathering testimony from women across the country who had been humiliatingly denied credit for the same reason. Married women told stories of being denied a mortgage in their own name because a lender assumed, without asking, that she was of what the industry euphemistically called childbearing age and might soon leave the workforce. Divorced women found their entire credit history simply vanished from the record, filed for years only under a husband's name, forcing them to essentially start their financial lives over from nothing at the exact moment they most needed credit of their own. Working with organizations like the National Organization for Women, Card helped compile a report on gender-based discrimination in banking, supported by thousands of letters from women who had lived through exactly this humiliation. In Congress, a representative named Margaret Heckler took up the legislative fight in earnest, doing much of the difficult work of finding allies and steering the bill through a skeptical committee. And in one of the more remarkable moments in the bill's history, another Congresswoman, Lindy Boggs, personally and quietly inserted language banning discrimination based on sex and marital status into the bill during a committee markup, without telling her colleagues beforehand, then calmly informed them afterward that she was certain the omission had simply been an oversight, and that she had taken the liberty of correcting it. The committee, perhaps too surprised to object, approved it unanimously. The result was the Equal Credit Opportunity Act, signed into law in October of 1974. For the first time in American history, it became illegal for a lender to deny someone a loan because of their sex or their marital status, a change that reshaped what financial independence even meant for millions of American women overnight. 2 years later, in 1976, Congress expanded the law further, explicitly outlawing credit discrimination based on race, color, religion, national origin, and age as well. The private, informal judgment that had ruled American lending for over a century, judgment that had so often been indistinguishable from prejudice, was now, on paper at least, illegal. But laws alone could not prove whether banks were actually complying, since a quiet denial across a desk left no public record for anyone to examine. So in 1975, Congress passed a second, quieter but equally powerful law, the Home Mortgage Disclosure Act, which forced lenders to report exactly where their loans were going, neighborhood by neighborhood, year after year. For the first time, researchers, regulators, and journalists could pull hard data and see, in unmistakable numbers, exactly which neighborhoods were still being systematically starved of capital decades after the original Hulk maps had first drawn the lines. The old system could no longer hide behind vague claims of prudent lending. The maps were now made of evidence, not just accusation. The old world of personal judgment, intimate, subjective, and for over a century quietly weaponized against millions of Americans, was legally finished. But abolishing a practice on paper does not automatically remove the bias from the men still making the decisions. Loan officers did not attend a mandatory seminar and emerge free of the assumptions they had carried their entire careers. They simply learned to phrase their denials more carefully, citing vague concerns about a neighborhood's stability rather than the race of the families living in it, while the outcome for the applicant remained exactly the same. If bankers could no longer be trusted to judge fairly, something else would have to replace their judgment entirely. And, improbably, the answer had already been sitting quietly on the shelf for nearly 2 decades, waiting for the country to be ready for it. Long before Congress passed a single one of these laws, 2 men in California had made a strange, almost heretical bet that a mathematical formula could judge a stranger's creditworthiness more fairly and more accurately than a human being ever could. Their names were Bill Fair, an engineer, and Earl Isaac, a mathematician, an unlikely pairing of disciplines for what they were about to attempt. In 1956, they founded a small company together, Fair, Isaac and Company, built on a radical premise for its time, that a person's likelihood of repaying a debt could be calculated from patterns in data rather than guessed at from a loan officer's gut feeling about a stranger's face. It was, in its way, a quiet rebellion against the entire century-old tradition of character-based lending, a bet that numbers, stripped of a human being's assumptions and prejudices, could actually see a borrower more clearly than the borrower's own neighbor could. Fair and Isaac spent years trying to convince a skeptical banking industry that a formula built from statistics could outperform the judgment of experienced loan officers who had spent entire careers trusting their own instincts. 2 years later, in 1958, a small consumer finance company became the first lender in the country willing to test their idea, using an early version of their scoring system to help decide who received credit. For decades, this remained a niche tool, used quietly by a handful of individual lenders, each with its own private version of the formula, calculated from that lender's own customer data. It solved a technical problem, helping a lender sort through applications faster and more consistently. It did not yet solve a moral one, the very problem now dominating the national conversation after the 1974 and 1975 laws exposed just how deep discriminatory lending really ran. That is where the 2 threads of this story, the mathematician's formula and the civil rights fight over fair lending, finally converged. If Congress had just made it illegal to judge a borrower by their race, sex, or marital status, then lenders needed some other way to judge risk, a way that could, in theory, ignore everything the old system had cared about and focus solely on the numbers, payment history, debt levels, length of credit, and nothing else. Fair and Isaac's statistical model, quietly developed and refined over 3 decades, was exactly that kind of tool, a system built, at its very core, to be blind to the things a human loan officer had never quite managed to look past. In 1989, Fair, Isaac and Company partnered with Equifax, one of the nation's credit bureaus, to launch something the country had never seen: a single, standardized credit score, built on a consistent formula and available to lenders everywhere, no matter which bank or which city a borrower happened to walk into. It ran on a scale from 300 to 850. Within a few short years, the other major bureaus adopted the same scoring approach, and by the early 1990s, this single 3-digit number had become the emerging new language of American lending, replacing, city by city and bank by bank, the private, subjective judgment that had ruled for a century and a half. Within a handful of years, the giant mortgage institutions that backed the majority of American home loans began requiring the score on nearly every application, cementing it almost overnight as the new gatekeeper standing between a family and the front door of a home. The change did not happen overnight, and it was not universally embraced. Loan officers who had spent careers trusting their own instincts were being told, in effect, that a formula understood their customers better than they did. Some resisted, arguing that no algorithm could capture the nuance of a real person's circumstances. But the advantages were undeniable, and they mattered enormously to the very civil rights struggle that had made this moment possible. A credit score does not know whether the applicant is black or white, male or female, married or single. It does not see a face across a desk. It does not know which church a person attends or which side of a red line they happen to live on. It reads only a history of borrowed money and how reliably it was repaid. For millions of Americans who had spent generations locked out by human bias, this was a genuine, hard-won victory, a system finely designed, at least in principle, to judge the debt and not the debtor, the payment history and not the person's face. But the victory came with an uncomfortable asterisk, one the story cannot honestly end without acknowledging. A credit score is only as fair as the data it is built from, and the data available to build those very first scores, in the 1980s and 1990s, was itself the product of over a century of exactly the discrimination the score was designed to eliminate. Families who had been redlined out of homeownership for generations had less credit history to show, because they had been denied the loans that would have built one. Communities excluded from the post-war wealth boom had less accumulated financial stability to draw on, because that boom had been engineered, by federal policy, specifically to pass them by. A grandfather locked out of a mortgage in 1950 could not pass a paid-off home to his children in 1980, and those children could not pass inherited equity to their own children decades later, a compounding absence that no formula, however mathematically pure, could see or correct, because the formula was never asked to look backward. The old bias had not been erased. It had simply been encoded, quietly, invisibly, into the historical record the new system was built to trust. This is the paradox at the very heart of the credit score's origin. It was born from a genuine, hard-fought effort to remove human prejudice from American lending, championed by people who had personally lived through that prejudice, and it inherited, in its very foundations, the scars of the prejudice it was trying to replace. Today, that 3-digit number governs almost every major financial decision an American will ever make: the mortgage on a first home, the interest rate on a car, the very ability to rent an apartment or open a credit card, sometimes even the terms offered on a simple cell phone contract. It arrived not primarily as a convenience, though it is certainly that. It arrived as the hard-won answer to a century and a half of documented, provable discrimination that once ran not through the shadows of American finance, but straight through its official policy, printed in federal handbooks and stamped onto federal maps. What most people misunderstand about the credit score is exactly this. They see it as cold, impersonal, a machine that has replaced human warmth with sterile math. But the human alternative it replaced was never as warm as nostalgia suggests. For millions of Americans, black families locked out by a red line on a government map, Women turned away for lack of a husband's signature, immigrants judged by a stranger's private prejudice recorded in a ledger. The human system was never fair to begin with. The number did not take away a golden age of personal trust. It took away a system where trust was so often just another name for exclusion, dressed up in the comfortable language of prudent, sound banking. And the story is not finished. The very data that still trains today's lending algorithms carries the fingerprints of neighborhoods once marked in red, families once denied the mortgages that build generational wealth, decades of exclusion quietly compounding into modern disparities in credit access and homeownership that persist along strikingly similar lines even now. Disparities that, when researchers overlay them onto the original Hulk maps from the 1930s, still trace an unsettling resemblance to lines drawn nearly a century ago. The fight to build a truly fair lending system did not end in 1989. It simply moved from a banker's private opinion into the data itself. And that fight, over whether a number can ever fully escape the biased history it was built from, continues in courtrooms, in Congress, and in credit reporting offices today. So here is the question worth sitting with. For a century and a half, America let one man's private judgment decide who deserved a chance at prosperity. And for millions, that judgment was never really about money at all. The number that replaced him was not cold by accident. It was built, hard-won, out of a fight to make lending blind to everything except the numbers themselves. Would you rather a human being or an algorithm decide whether you get a loan? Do you think the credit score has actually made American lending fairer or only faster? What would it even take to build a lending system that was finally, truly blind to everything but a person's own actions? Tell us what you think in the comments. Because the question of what true fairness in lending would even look like is still, in many ways, unresolved. And this is far from the only invisible system quietly built out of a fight nobody remembers today. Because there was once a time when a single visit to a hospital, a single difficult childbirth, could bankrupt an entire American family in a matter of days, when there was no Medicare, no employer health insurance as we know it, and getting sick was simply a financial gamble every family silently accepted as the cost of being alive. So how did ordinary Americans survive illness before health insurance existed? And who finally decided that a nation this wealthy should stop letting its people wager their life savings against their own health? That story is coming next, and it will change the way you look at every medical bill you've ever received.